Hey everybody. So I know I'm getting calls every day. People are dying to refinance. What they're really wanting to do is lower their payment, lower their interest rate. So let's talk about that. First thing we're going to cover is a rate and term refi. That's what most people want to do right now. That essentially equates to lowering their interest rate, hopefully lowering their payment. What we're also going to cover is a cash out refi. So let's cover rate and term first. First thing you need to understand is a refi is a whole new loan. It's not free. There are closing costs associated with the refi. So definitely always get a quote so you understand what the costs of the loan are. Are you covering money? Are you rolling those costs into your loan? Are you paying those closing costs out of pocket? Most of my clients want to roll their closing costs into the loan amount, which I also agree. I don't really see the benefit unless you just have money burning a hole in your pocket. So there's usually a general rule of thumb that you want to wait till rates are 1% lower than your current rate in order to do a refi. There's not a hard and fast, like that's not a mortgage guideline. There's not a specific rule about that. The reason people say that is that's kind of where you break even. However, there are other things to consider. So always get a full quote and always look at your costs of the loan. How much equity have you gained and what are your long-term plans for the house? So when should we pull the trigger? There's a little bit of math in that, a little bit of an educated guess, a little bit of looking into your crystal ball. But what you do want to look at is how much money are you going to save and how much are the costs. Then from there, I just do your break even. So say your costs are $5,000 and you're saving $100 a month. That's going to take you 50 months to break even. I don't like that as much. Ideally, I'm looking for probably under 2 years on your break even. So if your costs are $5,000 and you can save $200 a month, your break even is 25 months. I like that a lot better. I would probably pull the trigger on that. Then from there, you got to look at your crystal ball and decide, is this the best time to do it? We can usually project rates pretty good in a short term, but over the long term, it's really a guess. There's too many factors that affect the mortgage rate. So right now, it's like if you have that opportunity and it makes sense, I think you take it. So that's just kind of your straight like 30-year loan to 30-year loan rate and term refi. Maybe there's a scenario where you want to go from like a 30-year loan to a 15-year loan. That's a different calculation. You're going to be saving on interest, but most likely your monthly payment is not going to be lower. So in that scenario, I'm kind of looking at more of a long term. How much are your costs versus what are your interest savings by doing that shorter term loan and getting the better interest rate? How long do you break it even that way? So you are going to be paying more, but more of your payment is going towards the principal of your loan. You're paying down that balance faster. So that's a little bit of a different comparison. Right now, in the high cost, high rate environment that we're in, most people are just, the goal is to get that payment down as low as possible. All right, second kind of common scenario is a cash out refi. So this is completely different. You're pulling money out of the equity of your property to do kind of whatever you want. Common reasons for that are debt consolidation or home improvement. There's no restriction on or requirement on what you use that money for. I don't really recommend you like pull equity of your house to like go on vacation, although you totally can. What I like to see people use it for are debt consolidation or home improvement. If you have equity in your home, that's your money. We can look at like how can we leverage that. So if you're one of those really lucky people that got a super smoking rate during COVID and you don't want to lose that, we can do a second mortgage, a home equity line of credit. I'm not really going to get into a ton of detail on that, but That's a good option if you have one of those really low rates on your first mortgage. If you're not in that category and you're not really worried about losing your current rate, hopefully rates are around the same or better, you've gained some equity, you can redo your loan and pull cash out. If you are using that for debt consolidation, that's a pretty easy calculation to run too. Say your payment increases by like $300 a month, but we've paid off $700 a month in your other consumer debt. Say we pay off your cars, all your credit cards. Now all you have is a house payment. I love that situation. So obviously your mortgage payment has gone up, but your overall cash flow is better. Overall, you've saved $400 a month in your total outgoings. You can take that $400 and put it right back onto the principal of your loan amount, or put it towards the principal of your monthly payment. You will pay down your mortgage really quickly. That way we can run some amortization calculations on that too. I always like to have people save as well though. So what I usually say is like pay $200 a month towards the principal of your loan, save the other 200 and start, saving up some cash or investing that. Put that in your investment account so that money can grow for you too. So you're kind of taking the savings, paying down the balance of your loan to kind of offset the increase, hopefully pay off your loan faster, but also saving up some cash so you don't have to tap in to your credit cards or borrow money for a car again down the road. So if you're going to do cash out to consolidate debt, I strongly encourage people to really save that money. You don't want to pay it off and then accrue a bunch again and do the whole loop again. If you're going to use your equity for that, hopefully the goal is to not accrue a bunch of credit card and car debt. Now, if you're doing home remodels or using the money to buy something else, that's really more of a desire thing. If that does anything to increase the value of your home is really hard to project. If you're going to do that, you're going to use that money because it's something you really want and need, and that's totally okay too. So those are the two most common types of refis. Those all fall under different loan programs, conventional, FHA, VA, etc. I will do another video on FHA Streamlines and VA IRRRLs, which is a specific type of refinance that doesn't really get talked about enough. Hopefully that has helped you understand the refi process. Drop me some comments if you have questions. If you want to look at some numbers for refi, we can always run that. But hopefully this was helpful, and talk to you soon.